Good afternoon, everybody. My name is Paul Myliotis. I'm Joint Managing Director of M Squared Capital. I have with me today Paul Miron, my joint founder. Today we'll be talking about how do you preserve your capital in a market crash. Before we start our presentation, I'd like to draw your attention to the disclaimer, which is basically saying today we're providing general information only, and what we say should not be construed as advice. We'll start the presentation with just giving you a brief rundown of who we are and what we do. So M Squared Capital are a private credit provider, otherwise known as a non-bank lender. We match borrowers who need money with investors that have money.
Or like to invest money.
Or like to invest money. Our investors get paid monthly. Importantly, our investments are first registered mortgages over real estate assets based in the eastern seaboard of Australia. So today we'll be talking about how do you preserve your capital in a market crash.
In such an uncertain time that we're living through today, how do you create certainty when you're investing? So what we are certain of, and a lot of people out there are thinking of it at the moment or any point of time, there are certain markets that go up and certain markets go down. There might be a correction around the corner, or there could be a crash. So at the end of the day, we have three key principles in relation to what people should be thinking about when they're investing their money as well in relation to their portfolio.
Yeah, look, the three key principles that we'll run in turn through are diversification. The second one being understanding asymmetric risk, and the third one is being continually invested in the market.
So let's go through diversification. So
look, diversification is not a new concept, let's be honest. It's the concept of not putting your eggs in one basket. However, even within the mortgage trust space, there are different asset classes within the one asset class. So the misconception that we have are that pooled funds are diversified. Now they can be, but if pooled funds are only within one asset class, for example, if a pooled fund only does construction, or if a pooled fund only does industrial assets or commercial assets, we believe that that actually is not diverse, doesn't provide diversification. It's one product.
And we've learned from COVID, we've learned lessons from COVID that you might have a black swan event that only affects one particular part of the market as well. So you've had, for example, the airline industry. You've had retail. You've had certain things such as that as well. So you might have concentration of the one risk in your pooled fund. So it's not the same.
So on that note, M Squared Capital operate a contributory mortgage fund. Now that might be a concept that is foreign to you. What contributory mean is we provide our investors the tools to actually provide their own diversification by individually choosing which investments they specifically want to get involved in.
Absolutely, because look, our belief as well is a very strong belief, and through all of our experience as well, is that not a single mortgage is exactly the same as well. It's not a homogeneous good. So for example, is that we give the ability for the investors to choose a specific one that is best suited for them. So you can create your own portfolio within the mortgage space using our tools.
Yep, and look, our investors are telling us they're liking that concept. So we've got people that will have a little bit of money in each particular asset class: industrial, commercial, residential. Yeah. So now I know the next point is very close to your heart, Paul. You love speaking about this particular aspect, which is understanding asymmetric risk.
Well, look, if you actually look at the best investors, the best and most successful investors understanding asymmetric risk. So understanding risk and reward, which is very, very important. So how much of my capital am I risking to be able to get a return? So why that is so important is that in the current market, and look, in even previous markets, a lot of people have the emotion dictate in relation to the investment process. So very professional investors, they understand that relationship, but more importantly, they understand what asset preservation qualities of the investments are, and they mitigate it.
Look, let's be honest, when you lose your capital, to make that capital back, you actually have to go even further up the risk curve, which puts your capital at risk again. So the number one thing you try to do is preserve that capital at all costs.
Yeah, absolutely. And you're always chasing that high return to make up for a bad decision previously.
Right. Now, There's a reason why our chairman, John Thomas, has not lost a single dollar in his illustrious 44-year career. Now, John Thomas ran Howard Mortgages, which was in its time, its biggest mortgage fund, and it was running over $3.4 billion. We follow the same principles John Thomas follows.
Absolutely. And you know what it comes down to as well? Irrespective of what's happening in the market, it's actually following the following principles. And the following 5 C's that we're going to go through right now as well, it allows to understand the full asymmetric risk in relation to the investment that you're doing in the specific mortgage. So what are they? What are we looking for? We're looking at collateral. What is the security that we're actually using as well? What's the strength of the security? In the likely event that we have to recover, how quickly will it take us to recover it? Is there a depth of market? And importantly, we talk about this a lot as well, is that we don't like specialised security because it doesn't give the liquidity in that particular event.
Define as specialised security, Paul. We're saying no pubs, no bowling clubs, vacant land in regional Australia. There's a number of them, no service stations.
And nothing that has a going concern value as well.
Right.
So the other thing that we look at, which is quite important, is a character. Who is the actual borrower? How has he performed under stress previously? What has he banked with major lenders before? We do character references. We do searches on them as well. This is really important. Next one is capacity. Does this particular borrower has a strong enough balance sheet to withstand a shock or unexpected shock? So you don't want to be lending, for example, to a person that only has one property, one security. You want to make sure that he has other assets that he can fall back on to preserve and meet his obligations with our mortgage. The other one is cash flow. Now, cash flow is so critical. Is he going to be able to afford to pay the repayments on a monthly basis? We talk about that. Our investors rely upon the monthly income. So we need to make sure that our borrower has the ability to make those obligations as well so that we can give to our investors. The other one is competency. You want to be lending money to people who are competent in that particular field as well. So the combination of these elements is what we determine as a risk in relation to a particular mortgage. And we believe that our investors have the privilege and right to actually understand and see that information on every single time they invest.
Look, I think it's also having the discipline to follow that 5C process every single time. And in our business, it's a non-negotiable.
Yeah.
The third aspect is being in the market. Now, we get asked a number of times during COVID, how did you fare? In fact, how did you actually double your funds under management in the hardest possible time in the space? And we'll explain why. There are 2 key aspects that you need to be very aware of when you are investing that actually allows you to, with confidence, invest. Now, as Paul mentioned before, our investors rely on their monthly distributions to live on. It's not good enough in a market shop not to pay those investors. So understanding the resilience of the property market is the first aspect. And the second one is the Keynesian economic theory. So on the first aspect, I'll draw your attention to this graph that we've done. Now, we predominantly lend against security based in Sydney. So I've provided the Sydney graph for you. The biggest drop in residential values in Sydney was in 2016, which was about 18%, was when APRA came in and put the brakes on the property market.
Well, just to expand on that, it put the brakes on the property market by making it much more difficult for borrowers to borrow money from the banks.
Right.
That basically wasn't, so that was a induced cap on demand, not necessarily to any external factors at all.
Right, and in saying that, we're talking non-specialised assets here. If it was specialised, the 18% drop would have been a lot worse. So when we are lending in our business, 65% of the value of a property, so for $1 million property, we only lend $650,000. For our investors to actually lose money, the property must have dropped 35%. So when we went back to the fundamental principles of the property market in Sydney, where the predominantly our assets lie, we slept at night knowing that it's a resilient property market and our investors got their money back every single time. And more than that, the monthly distributions were paid every single time during COVID to our investors.
So the other one that gave us a lot of comfort as well, and look, there's articles that I was writing all the way through last year trying to explain this as well. When COVID hit, the first thing that we saw that the government was doing is that we were supporting the property market They were supporting the market by the unprecedented policy that they were putting in place, fiscal and monetary as well, dropping interest rates and making sure there was, as we conserved as many jobs as possible. So at the end of the day, is that Keynesian theory is appreciated by the government, knowing that if we are not comfortable in relation to our wealth and our asset class, which is property, not being protected, we're less likely to spend money. If we're not spending money, the economy goes backwards.
So just to summarise those 2 points, we're very comfortable that the property market would bounce back. The second point, we knew that the government, as a worst case, would shore up the property market, because if they didn't, we would feel not as wealthy as we are, and then we'd make bad decisions which would actually would be catastrophic.
The economy would not have the ability to recover the way that it has played out in the last couple of months.
Now, we can talk all day about these type of things. We'll leave it there, but if you liked what we spoke about and you actually want to see more from us, what type of investments we have, the only way you can do that is by sending us an email at info@msqcapital.com.au. Also, you can call Paul or myself. Our numbers are on the screen at any time. We'd love to speak to you. Thank you.
Thank you.